Okay, let's dive into some source material today. We're looking at a specific corner of the investment world.
Yep, we've got an article here called Leveraged ETFs, Risk, Reward, and Strategy.
And our mission really is to unpack what these leveraged ETFs actually are.
And maybe more importantly, understand why they have this reputation for both big potential rewards and, well, pretty significant risks, especially if you hold them for more than just a day.
Right, so maybe start with the basics. The source reminds us what a regular ETF is, an exchange-traded fund.
Yeah, simple enough. It just tracks an index, like the S&P 500 or...
And it trades like a stock, right? Moves with the index, flexible to buy and sell all day.
Exactly. Now, a leveraged ETF, it adds a twist. It's built to give you a multiple like 2x or 3x of the daily return of that index.
Okay, so index up 1% today.
Your 2x ETF aims for up 2% just for that day.
And I saw they have inverse ones too, like minus 2x.
That's right. And the inverse one does the opposite, but multiplied. Index up 1%.
The minus 2x aims to be down 2% for the day.
This is where the article immediately flags something huge. You really need to get that multiplier, the 2x or Nagus 2x.
It only applies to the daily change.
Just the single day's performance, not the week, not the month.
And this daily reset, it's the absolute key. It explains pretty much all the tricky parts that come next.
It seems like that's where the long-term risk really creeps in. The source talks about how holding these, even if the market is just flat over a few days, you can still lose money.
Right. It's kind of counterintuitive.
So let's dig into why. Why does that daily reset cause problems? The source gives a few key reasons. First one is compounding distortion.
Yeah, they use a good example. Say, day one, the index jumps 10%. You started with $100 in a 2x ETF.
Okay, so you're up 20% that day. You've got $120.
Right. But then, day two, the index falls back 10. But your ETF, it drops 20% from its new higher value of $120.
Ah, so 20% of $120, that's $24 down.
Exactly. So your $120 becomes $96. Wow. So the index is almost flat, but the 2x ETF is down 4%.
That's the compounding distortion. The daily stacking just doesn't work out the same as applying leverage over the whole period. It can really mess with the long-term picture.
Okay, that makes sense. What's the next risk?
Well, linked to that daily reset is something called volatility drag, or sometimes volatility decay.
Okay.
Basically, because the fund has to rebalance every day using derivatives to hit that 2x target for the next day.
Right. It needs to adjust its bets daily.
Yeah. And in a choppy market, one that swings up and down a lot, it ends up kind of buying high and selling low relative to its target each day. That constant adjustment
creates friction, costs.
Exactly. Transaction costs, slippage. These things slowly eat away at the value. Even if the index just tread water and goes sideways overall, it's a drag from the volatility.
So hidden costs are baked into the daily mechanics too.
Definitely. Rebalancing costs are a real factor, chipping away at performance.
And the source mentioned one more thing, the human factor, emotional pressure.
Oh, yeah. Because your gains and losses are magnified. A market dip that might feel manageable normally.
Could mean your 2x ETF is down 5%, maybe 10% in just one day.
Right. And seeing those big, fast drops can really, trigger panic. People might sell at exactly the wrong time out of fear.
So discipline is absolutely critical.
Hugely important. So when you think about all these things, the compounding issue, the volatility drag, the costs, the emotional side, you absolutely need to wrap your head around these specific risks before you even consider using these tools.
Okay, so given all that, the source is pretty clear. These are not buy and hold investments for the long term.
Definitely not. They call them tools for specific strategies.
Which brings us to, well, when should someone think about using them, according to the article, if not long term?
The main idea is when you have a really clear market direction, you're pretty confident the market's about to make a sharp move up or down soon.
Okay, strong conviction. Or maybe for really short-term trades.
Yeah, the source suggests like 1 to 3 days maybe.
Yeah.
Based on news or momentum you see, or maybe a technical pattern.
Which I guess connects to their third point, chart-based entry, using technical signals.
Right. Like if you see a clear support or resistance level on a chart and you think it's about to break out quickly, you might use a leveraged ETF to amplify that short-term bet.
And this seems vital. The source has a huge warning, doesn't it?
Absolutely critical.
Mhm.
Always use a stop-loss order.
Because if you're wrong,
Your losses get magnified just as fast as any potential gains. You need that safety net.
okay. So let's try to pull this together for everyone listening. The main takeaway seems to be a leveraged ETF is a specialized tool.
Yeah, very specific. Designed for short-term moves if you have a strong view. It's just not built like a normal long-term investment.
And whether it works out or ends up costing you more than expected really depends on a few things.
Like fully understanding how that daily reset works.
Having a clear plan entry, exit, stop loss before you trade.
And having the discipline to stick to that plan, especially when those magnified swings start happening.
If you tick those boxes, maybe it can be a powerful tool. If not,
The way compounding and costs work could lead to some nasty surprises.
so maybe the final thought for you to mull over is this.
Given everything we've discussed about that daily compounding effect and the volatility drag, how much conviction do you really need in your short-term market call to make taking on those amplified risks actually worthwhile for your strategy?
Something definitely worth thinking about.